Okay, so welcome everyone to our session on exchange rates, macroeconomic and behavioral drivers. First up, we have a paper by Ralph Koijin and Motohiro Yogo presented by Moto, and it's on exchange rates and asset prices in a global demand system.
Thank you. So in this paper, we're thinking about determinants of exchange rates and asset prices together. And then there are two key players in the way we're thinking about exchange rates. So there are global investors that hold financial assets across many asset classes and across different countries, who can substitute both within and across asset classes. And their portfolio demand is going to depend on exchange rates and asset prices, as well as a bunch of macro variables. And on the policy side, we're going to think about how short-term rates, so central bank policy rates, as well as the quantities of debt outstanding can affect both asset prices and exchange rates. So we put together data on global financial markets from 2002 to 2017. And our sample periods dictated by the availability of IMF's Coordinated Portfolio Investment Survey, which has the bilateral portfolio holdings across countries. We also have exchange rates, bond yields, as well as equity prices across 36 countries. And the way we're approaching asset pricing is kind of going to the micro foundations of all asset pricing models, which is there's a portfolio choice, plus market clearing pins down all the asset prices. Now, this approach that we're taking, which we call demand system asset pricing, is different from like previous attempts in asset pricing, where we take the quantity or the portfolio data seriously to the point that we want our model to actually match the portfolio holdings exactly. So typically, the way we do asset pricing is we specify preferences and beliefs and so on, and we get implications for portfolio choice, but we usually test our models just on asset prices, but not actually use portfolio holdings data. So that's kind of like what's different about the way we're approaching things. And we're going to use this demand system to decompose variation in exchange rates and asset prices. We can also use it to do event studies, to study things like the European sovereign debt crisis. And we also have an application where we estimate the convenience yield on US assets. We have annual data on 3 asset classes: short-term debt, long-term debt, and equity. And the countries that are holding the assets, we call them investors or investor countries. There are 88 countries, plus foreign exchange reserves is the aggregated positions of all central banks who hold foreign assets. And these are aggregated because some central banks require confidentiality of their holdings. These investors invest in 36 countries. We call them issuer countries. And these 36 we focus on because we have complete data on their asset prices, as well as macro variables. And these 36 include all 22 countries in the MSCI Developed World Index, as well as 14 of 21 countries in their Emerging Markets Index. And all the other countries that are outside of these 36, we call it an outside asset, which is, so then everything aggregates to world wealth. We defined a supply of assets as for equity, it's just straightforward total stock market cap of each country. And for debt, we do zero net supply accounting. So the total US Treasury debt that's held by foreigners is what we call as a supply of US Treasuries. So domestic holdings actually net out because it's both an asset and a liability through future taxes. We have top 10 investors in each asset class is summarized in this table. So if you look in the short-term debt column, the biggest investor or the holder of foreign short-term debt are the central bank reserve holdings. And that amounts to $912 billion US dollars in 2017. Of course, large countries like US and France show up in the top 10 investor list. And one aspect of our data that we need to be mindful of is we also have lots of holdings that go through Ireland, 527 billion, as well as Luxembourg and the Cayman Islands. These are the offshore financial centers, which mean that, for example, in Luxembourg, there are a bunch of money market funds. So European investors invest in money market funds that are domiciled in Luxembourg. So those count as in the CPIS, they're accounted for as holdings of Luxembourg. But the way I want you to understand is Luxembourg is actually just an aggregated, think of it as an aggregated money market fund position of other European investors. In the long-term debt market, we also have over $4 trillion that are held by these reserves. Japan is a major holder of foreign long-term debt amounting to more than $2 trillion, as well as the US, Germany, and so on. And in the equity market, US has $32 trillion in both domestic and foreign equity holdings, as well as China, Japan, Hong Kong. These are the top holders of equities. All right, so we start with just an accounting identity. There's a market clearing equation for each asset that we care about. So Q is the quantity of the asset. So for example, in the case of debt, this is the book value in the local currency. So like this is the book value of UK debt in pounds. If you multiply that by the dollar to pound exchange rate, you get the book value or the face value of UK debt in pounds, or sorry, in US dollars. And if you multiply it by the market to book ratio, then you get the market value. So the left-hand side is the market value of UK debt in dollars, right? When you multiply by the price and exchange rate. The right-hand side is the demand. So in each country I, there's wealth AI, and the portfolio share WIT is a share of country I's wealth that's allocated to UK long-term debt. And of course, portfolio choice depends on the vector of prices and exchange rates here. So you can think of this as a system where there's a fixed point. There's a vector of prices and exchange rates for all assets such that market clearing holds for all assets in all countries. Okay, so just think of this as a big fixed point problem where we're solving for asset prices and exchange rates simultaneously. So every asset pricing model has to satisfy market clearing, of course. So the only thing that's different about different asset pricing models is they imply different things about the portfolio rules. Okay, and we have a particular way of specifying the portfolio rules in a way that we can simultaneously match all the portfolio holdings. And the way we're going to approach this in this paper is there's short-term debt, long-term debt, and equities. So they're the three different asset classes. In the short-term debt market, there's 26 countries plus the Euro area has 10 countries in our sample. So they have a common short-term rate. If you condition on the short-term rate that's determined by central bank policy, then the system of equations uniquely pins down 26 bilateral exchange rates relative to the US dollar, 36 long-term yields, and 36 equity prices. Okay, so because there's both exchange rates and short-term rates, long-term yields, and equity prices, right? There's more asset prices than there are equations unless you condition on this vector of short-term rates, then that allows us to uniquely pin down exchange rates, long yields, and equity prices. So to complete the model, we just need a model portfolio weights such that the cross-country holdings and the data matches the portfolio model exactly. We can take the system of equations to estimate demand elasticities, and it allows for realistic and flexible substitution patterns both within and across asset classes. So we build on our previous work that was published in the 2019 in the JPE, where we started with sort of classic portfolio choice. So the vector portfolio weights is the inverse of the covariance matrix times the vector of expected return. So these are like the Markowitz mean variance portfolio weights. And now we index both the covariances and expected returns by I to allow for the possibility that they have heterogeneous beliefs about returns across investors. And it turns out that if you assume that there's a covariant structure in returns and that expected returns and factor loadings depend on characteristics, then these assumptions allow you to write the portfolio holdings. So this is the portfolio weight of investor I and asset N as a log linear in prices, characteristics of assets, which capture things like riskiness of these assets, and part that's unobserved to the econometrician, we call it latent demand. Okay, so this portfolio function is now something that looks in logarithms, it looks like a linear regression that we can actually take to the data. Now, relative to our 2019 paper, we did two extensions. So one is because there's different countries and different asset classes, we use a nested logit structure, which is essentially the portfolio weight in country N in asset class L is the within portfolio weights, portfolios within asset classes times the portfolio weight in the overall asset class. Okay. And we can use the nested logit structure to model the within and the across portfolio weights. And the other thing we did was because there's both exchange rates and for example, bond yields in the case of long-term debt, then we want to aggregate exchange rates and asset prices in a way that captures the trade-off between different countries. So the way we do it is we estimate a predictive regression for each asset class in each country. So, this is the return, for example, on UK debt in dollars. Minus the US short-term yield. You regress that on the market to book ratio and the real exchange rate, right? It's a predictive regression, and that gives you an estimate of expected returns on UK debt. And now you can change the units to the local currency unit. So for example, in the case of Japanese investors, they care about the returns in yen. Right, so if you subtract the nominal appreciation of the exchange rate minus the short-term rate in Japan, then that gives you the expected return of Japanese investors on UK debt. Okay, so essentially we set up the demand system so that in each country, so for example, Japan, they care about expected returns in yen, and we aggregate both exchange rates and asset prices in a way that what enters the portfolio functions are the expected returns. Okay, so we have a bunch of variables that we put into the demand function. So the macro variables are GDP, inflation, equity volatility, sovereign debt ratings. We have bilateral variables like import shares and physical distance between the countries that captures the gravity relationships. We also have a home bias dummy and a US issuance dummy interacted with EAR to measure the specialness of US assets. And then the identification, we have a IV estimation strategy that we developed in our earlier paper. And essentially it relies on the factor structure and returns that gives rise to, if you're willing to assume that asset characteristics and quantities, right? So everything other than asset prices are exogenous in the spirit of endowment economies, then you can aggregate these characteristics through market clearing to get an instrument for the price. Okay. So this is the estimated demand function within asset class. So for short-term debt, right, demand is increasing in expected returns. It has a near unit elasticity with respect to log GDP. And it has a negative coefficient with respect to inflation. So high inflation is bad news for the bond market, as well as high volatility is bad news. Demand is increasing in ratings, and you have the bilateral relations, gravity relations in exports, imports, and physical distance enters negatively. Okay, and you have a similar set of coefficients for long-term debt as well as equities.
Moto, you have about 5 minutes.
Okay, great. So once we estimate the demand functions, we can do asset pricing in the following way. So The market clearing defines an implicit function of exchange rates, bond prices, and equity prices as a function of the characteristics that go into the demand function, short-term debt prices or short-term rates, quantities of debt, and latent demand, right? So when you observe exchange rates or bond yields move from one year to the next, well, they don't move unless something changed, right? It's either there are macro shocks or central banks changed the short-term rate policy rules, or they changed the quantities of debt, or there's a latent demand shock. Okay, so we can decompose every movement in asset prices into what's causing that movement. Okay, so we decompose annual changes in exchange rates. 26% of the annual variation exchange rates is explained by macro variables, 8% by short-term rates, 2% by debt quantities, reserves explain 19%, and the remainder 45% is latent demand. But one advantage of our approach is we can decompose latent demand into whose latent demand is it? Is it North American investors, which explains 8%, European investors 8%, Pacific 3%, and so on. Right? So the residual, the unexplained part, we can further decompose geographically into which investors matter for movements in exchange rates. Okay, and interestingly, offshore financial centers, where a lot of money market funds are located, explain up to 25% of the movements in annual exchange rate movements. In the case of long-term bond yields, the important thing is the quantity of debt changes, right? Through fiscal monetary policy that explains up to 20% of the annual variation in long bond yields. And then in the case of equities, the key thing is 57% is explained by macro variables. Okay. Let me skip over, in the interest of time, the European sovereign debt crisis, and then focus on the specialness of U.S. assets. So there's a fairly large and growing literature on the idea that U.S. assets are special, and as a consequence, there's a convenience yield on U.S. debt. So U.S. debt trades at a low yield because foreign investors like to hold U.S. assets. But this convenience yield idea should not only be true for bonds, but also for cash dollars, as well as US equities. So we use the demand system to estimate what is the magnitude of this convenience yield. Okay, so the way we do it is we take the demand system and we zero out the specialness of US debt, which is the extra demand that foreign investors have for not only short-term debt, but long-term debt and equities. And we solve for the market clearing prices in the absence of specialness, right? And then what we find is that long-term debt yields, so long yields would be 2.15% higher in the absence of US specialness. And we can further decompose 2.15% into which investors are causing this. So 48 basis points of that's coming from reserves, 2% from North American investors, 51 basis points from European investors, and so on. Okay, so the sum of these investor impact on convenience yields sums up to 2.15%. Okay, so we can say geographically which investors really like US long-term debt and is causing the US long yields to be lower than it would otherwise be.
1 minute, Moto.
Okay, and then in terms of equities, right, 1.7 is in units of expected returns. So expected returns on US equities are 1.7% lower because of the specialness of dollar assets. Okay, and again, that's coming from different investors, in particular European investors, right, contribute 69 basis points towards the 1.7%. Okay. So kind of to summarize what we have, fundamentals is in observed macro variables and quantity variables can explain up to 55% of the annual variation exchange rates, 57% of the annual variation in long yields, and 69% of the annual variation in market to book equity, okay, stock prices. And one key finding is why do these investors matter so much? One is, and the key is because demand is inelastic for assets, right? So what we find is that for equity, for instance, we find a demand elasticity of like 1.9. So this is kind of similar to the elasticity of 1 that people find in the US equity index addition deletion literature. So elasticity of 1.9 implies that, right, like fairly small shocks can have large price impact, right, because investors have low substitution of equities across countries, right? And then we have similarly like lower than we thought estimates of elasticities for both long-term debt and short-term debt. And as a consequence, right, investor shocks can have fairly large impact on prices. And finally, a convenience yield on US assets is fairly large, and then agrees with some other estimates in the literature. In particular, for the dollar, we find a convenience yield of 1.2%, for long bonds, 2.1%, and 1.7 for equities. Thank you.
Thank you, Moto. And now discussing, we will have Helene Ray. While Helene's loading her slides, I'm just going to make an announcement that those attending as attendees, you can raise your hands if you wish to ask a question, and I will be able to unmute you. And we will have a couple of minutes for questions after the discussion.
Okay, can you see any slide here? Can you see the slides?
Yes.
Great, thank you. Okay, so thank you very much for asking me to discuss this paper. So I think it's a very important paper, actually, both for asset pricing and our understanding of exchange rates. There has been in the literature on exchange rate overwhelming skepticism at any attempt to explain exchange rates via macroeconomic factors or even fundamentals. And I think this is mostly due to a very famous and influential paper of Messi and Rogoff of 1983, showing that the random walk outperformed essentially any existing model of it at the time for short-term horizons out of sample. And so this skepticism has been, checked again by many other papers using similar approach to Messi and Rogoff. And so much so that there are many DSG models which adopt exogenous shocks to the UIP condition as a convenient modeling device. And indeed, this can be fine for many applications, but it's definitely worth revisiting the fundamental approach to exchange rate determination. And this is something that a number of recent papers have done, emphasizing very different fundamentals. So it goes from order flows to external imbalance variables, to preferred habitat model, to models of portfolio rebalancing, or to, as we will see later with the paper of Vanya and Jenny, using survey data and looking at the influence of macro variables in exchange rate decomposition. So I think this paper is extremely valuable because it brings to bear on the literature a new approach, which is based on IO. And it shows that there is a sizable fraction of the variance of exchange rate that can be explained by macroeconomic variables, and actually even more, it's about a quarter, and even more, like about half, which can be explained by fundamentals, which include policy variables like interest rate and also quantities. And it is also a very important approach in asset pricing because it takes very seriously the joint determinations of both prices and quantities, which is something that is very badly needed, I think, in the literature. So how do they do that, Moto and Ralph? Well, so they estimate a demand system for short-term, long-term bonds, equities, and exchange rates, and they use the CPIS data to do that.
Sorry, Helen, actually, we don't see the slides moving. We see only the first slide.
Okay. Can you see now?
No.
You cannot see. Okay, so I really wonder what. Okay, I'm going to share again, maybe.
Yes, now it's better.
Okay. So I accept that I am now too far. Okay, so here we go. So I'm hoping it's fine. So they propose this decomposition that Moto described, so I'm not going to dwell on it. And they use indeed the GPE paper for portfolio weights. What is new in that paper, and is very important, is that they allow for a rich pattern of substitution across assets, and also that exchange rates play a key role compared to their previous work. So how do they solve for this huge model with many countries and 3 types of assets? Well, so as Moto described, they use the market clearing conditions together with the asset demands. And what is important to see, I think, is that they use the market conditions on asset markets. So goods markets are completely out of the picture here. So in that respect, they are very much in the tradition of the portfolio balance models a la Curie, or some work which I've done with Harald Hau also in the past. And they have, in a way, too many prices to determine given the number of market clearing conditions. So one condition that they impose, which make a lot of sense, is that they assume that central bank policies determine short-term rates, and that the Fed adjusts the supply of short-term debt so that the market clears at a given rate. So this gives them a just identified system. Of course, in practice, monetary policies would be endogenous to macro variables, and but we leave that aside, and I think it makes a lot of sense to leave that aside and to take essentially the real side of the economy here as exogenous. So I think it's a very appropriate set of assumptions.
1 minute, Helen.
Okay, so they have very interesting results for how much of variation of the exchange rate is explained by macro variables, how much is explained by foreign exchange reserves, which is actually quite a bit, short-term rates and long-term debt quantities. I've put here the variance decomposition. This still leaves 45% of the variation unexplained, so some role for shocks are still there. And they have striking results on elasticities of various asset classes. Like Moto said, I think it's very important for our understanding of asset price volatility in the different markets and how portfolio flows can actually move prices quite a lot in different asset markets, especially in the equity market. Okay, so a few comments. So it's a very comprehensive coverage of international positions, but the CPIS data does not have the cross-banking exposures of BIS, for example, which are probably quite substitute with the short-term international debt position. So I would suggest here that some robustness checks could be to take that into account, maybe to add them up in order not to add too many equations. There's also some assumption that all debts are in local currency, but a large fraction of international debt positions are in dollars. So again, that could be a worthwhile robustness check to do. Maybe a more difficult question is, there's an assumption that investors value assets in their own currency, which is, I think, totally realistic. However, the bond investors have a different, it seems, hedging behavior compared to the equity investors. They tend to hedge for exchange rate risk. So it's not clear to me how that would affect the estimate that the offer get. And finally, in terms of offshore centers treatment, so they treat, it seems, the offshore center as investors. However, of course, when Bermuda invests in the UK, it's not a Bermudese investor, but it could be a mixture of US and European investor. And so that changes a little bit the way one would estimate the different market clearing conditions. Now, some more comments on the estimation. It's country level data. So there is no variations of investor loadings on asset characteristics within a country, which is fair enough. But one could wonder how the heterogeneity of assets of investors within a country could possibly bias some of the estimates. I'm not sure they can do anything about that with this data. However, I think it's worth keeping in mind. For the asset demand estimation that Moto showed, I think it makes sense to assume exogeneity of the macro variables on the real side. One could do a robustness check by keeping only the more plausibly exogenous variables, such as the distance, etc. Again, it's just a robustness check. And finally, I think the latent demand is obviously that's the most difficult identification issue, is jointly endogenous with exchange rate and asset prices in their estimation. So they have a very clever identification strategy using the market clearing condition as instruments. It's not clear to me, however, if the identification would be robust to a global asset specific shock, such as flight to safety. Now, the results are super interesting. Macroeconomic variables are important for exchange rates. The results on substitutability are super interesting. I was wondering whether they could have a way of understanding better the relevant margin of substitution for the exchange rate. Is it between equity investors and bond investors, or between short-term and long-term bonds? Who is rebalancing the portfolios? I don't know if they can say more about that, but I think it's a very interesting issue. The results on the importance of reserves for asset pricing are also very striking. Now, to finish, just very short comments on their two super nice applications. One is the euro area crisis. It would be nice to know whether ECB purchases of sovereign debt are actually used in the estimation or not. And there, I think it does matter what happens in terms of domestic investments, in particular, euro area banks likely to have very different demand elasticities compared to foreign investors due to financial regulation in particular. And how is Draghi's July 2012, whatever it takes, captured? Probably in the latent demand, but is there anything better that could be done with that? Clearly, didn't lead to any flow. It was purely an announcement that had very important asset pricing implications. The dollar special status is another great application. And it's very nice to see the decomposition of the convenience yield into different components. However, I think, again, we have the fact that the domestic holdings of debt...
Helen, we're actually really behind, so I think
I finished on that.
So we have to unfortunately skip the Q&A and the answers, and we have to jump straight into the next paper, and Jenny is going to introduce it.
Okay, fine. So absolutely, it would be great to see if other countries have a convenience yield as well, which they could easily do in that paper. So it's a great paper and very useful for policymakers as well.
Thank you, Helen. So for the next paper, we will have Priya Malavi presenting asset pricing with misspecified models.
Can you see the slides fine? Yeah, okay.
Yep.
All right, thanks for organizing and for including this paper. This is with Alireza Daba, Saleh, and Andrea Abedoli, who are in the audience. So now this is going to be a paper of, let me see if I can you see my second slide? Okay, so this is going to be a asset pricing without rational expectations. So let me at first talk briefly about the rational expectations assumption and why it might be a good idea to consider departures from rational expectations. Under the benchmark rational expectations assumption, agents are assumed to forecast the future, as well as if they knew all the shocks that hit the economy and their distributions. They knew the economy's structural equation, so could map the shocks to the payoff relevant variables and could construct the distribution of payoff relevant variables. and they were capable of Bayesian updating in light of new information. Now, this is obviously a very strong assumption. In reality, agents have limited cognitive and computational abilities. It could be that the agents have limited capacity for processing information, as in rational attention type models, so they don't know the shocks perfectly. Or it could be that the agents know the shocks perfectly, but they can't use the distribution of the shocks to construct the distribution of payoff relevant variables because they don't understand the general equilibrium effects. Or it could be that the agents can actually construct this probability distribution, but they do not follow Bayes' rule, either because of its complexity or due to psychological biases. Okay, so in this paper, we're going to start from a different premise. We're going to start with the assumption that the stochastic process that governs the payoff relevant variables may be a complex object that does not have a simple parametric representation. So this is kind of in the spirit of this old idea that the world is complicated, and as a result, we need to rely on simple models of the world in order to be able to make sense of it. Okay, so to be more specific, our agents will be facing limits to the complexity of time series models that they can use in order to forecast the future payoff relevant variables. And as a result, they're going to rely on low dimensional approximations to this probability distribution. So formally, we're going to have a sequence of payoff relevant variables. Think about this as dividends for an asset. They're generated by a latent factor model, in particular a factor model with n latent factors. We're going to assume that our agents are constrained to thinking through models with at most k factors, where I want you to have in mind that k is typically much smaller than n. So there are maybe thousands of factors out there that determine dividends to different assets, but the agents can think it through the lens of models with 1 or 2 or 3 factors. Our agents will be otherwise constrained rational. What I mean by that is that the agents perfectly observe the sequence of payoff relevant variables. They know all the general equilibrium effects. Essentially, they know all the no arbitrage conditions that determine the asset prices, and they're capable of Bayesian updating. The only departure from rational expectations is going to be that they're going to only hold and update beliefs over the set of k-factor models. Now, which k-factor models they're going to choose, that's going to be something that's determined endogenously by the agents as they update their beliefs. And we're going to show that endogenously in the long run, the agents will select the k-factor model that best fits their observations in a sense of Kullback-Leibler divergence. Okay, so what's going to be the outcome of this type of model? When k is large, the agents will essentially recover the true model. They're going to learn the true data generating process, and we're going to be back at the rational expectation. Now, when k is small relative to n, then no matter which k-factor model the agents pick, there's going to be a wedge between the agent's expectations and the true data generating process. So the expectations will exhibit systematic deviations from rational expectations, and as a result, there's going to be asset return predictability and asset prices, and that's going to be the focus of the paper. So let me jump straight into the model in the interest of time. We're going to make our model as simple as possible along all dimensions except for the determination of expectations. So this is going to be an extremely simple model and completely standard. There's a discrete time economy with a unit mass of identical agents. In the paper, we have an extension with heterogeneous agents, but I'm not going to have time to talk about it today. There's an exogenous sequence of fundamentals that we denote by xt. Again, you should have in mind that this is the dividend for some asset. They're generated according to some probability distribution that we denote by p star. So this is going to be an exogenous object. We're going to take it as given, but you should think about these p star as being some complex object that's hard to think through. So the agents have to rely on simplified versions of the p star. Okay, so the fundamentals are exogenously distributed according to p star. Then there's an endogenous sequence of prices that satisfy a simple risk neutral no arbitrage condition. So in particular, the price of the asset at time t is going to be equal to the dividend you get between time t and t plus 1, plus price at time t plus 1 discounted with some discount factor that's a parameter that's constant. And importantly, this is going to be according to the agent's subjective expectation. So the prices are determined by what the agents expect to price to be in the future. Now note that the agent's subjective expectations are in general going to be different than the true expectations that correspond to the true data generating process P star. Okay, now given this no arbitrage condition, we can define realized excess returns in a usual way. It's going to be the price at time t plus 1, discounted minus price at time t, plus the dividend you receive between period t and period t plus 1. Just to make things a bit more concrete, we can think about the asset as being some kind of equity where xt is the dividend that you receive on the equity, yt is the price of the asset, and rxt is the equity risk premium. Or we can think about foreign exchange markets where xt is the interest rate differential between two currencies. Excuse me. Yt is the exchange rate and rxt is the currency risk premium. All right. So I didn't tell you where the subjective expectations come from. Let me now talk about that. As I said earlier, we're going to assume that the true model is going to be an n-factor latent model. There are n latent factors denoted by ft. This is the vector of the n factors that follow some autoregressive process with Gaussian innovations. And the fundamental xt is some linear function of ft with a vector of loadings that is denoted by c star. Now, importantly, we're going to assume that the agents do not observe or know the underlying factors that affect the fundamental. They also don't know the collection of parameters theta star that describes the true process for the fundamental. Rather, the agents are going to rely on a set of subjective models in order to forecast the value of the fundamental. The agent's subjective models have the same form as a true model. It's a latent factor model, except that in the agent's model, the number of factors is k. So we have the same structure, the k factors that follow an AR process with Gaussian innovations, and the agents believe that the fundamental is some linear function of the k factors. Now this model has some parameters, A, B, C. These are matrices and vectors of appropriate dimensions. We're going to assume that the agents learn these parameters, and we're going to focus at the asymptotic limit where the agents have essentially learned whatever can be learned. But when k is smaller than n, even when the agents accumulate a lot of information, they still won't be able to recover the true model because they're starting with the prior that puts zero weight on the true data generating process. So even in the limit, their model is going to be misspecified, and this is going to lead to a wedge between the agent's expectations and the true data generating process that's going to manifest itself as a return predictability in asset prices. Okay, just one thing to highlight, the only exogenously specified feature of the agent's model is going to be k, at least in the long run. In the short run, the prior is going to be important, but we're going to focus on the long run, where the only thing that's exogenous is k. Okay, so how do the agents learn the parameters of their model? Agents start with some prior mu minus tau at some period minus tau. Think about it as some distant past period. The agent's prior has full support over the set of all k-factor models, but importantly, only over the set of k-factor models. So in particular, if n is bigger than k, the agents will assign probability 0 to the true data generating process. We're going to assume that the agents are rational, so they form Bayesian posteriors after observing the realization of the fundamental. So they have a prior, they observe the sequence of fundamental, they update their prior using Bayes' rule. Pretty standard, other than the fact that the prior puts zero weight on the true model. Now the agent's belief at any point in time is going to be a function of their prior and the realization of the fundamental they've observed up to that period, up to that time period. But in order to abstract from finite sample issues, we're going to consider the limit where the agents have had access to a large sample of the fundamental, and as a result, the effect of the prior has essentially died out, except for its support. Okay, so in the limit, the only thing that matters is the support of the prior. In particular, to be more specific, the agent's beliefs will concentrate on a set of k-factor models that best describe their observations in the sense of minimizing Kullback-Leibler divergence. Okay, so again, agents are fully Bayesian, but they have a prior that assigns zero belief on the models with more than k factors. Okay, now let me go to the focus of the paper, which is return predictability in asset pricing and return predictability return predictability, sorry. Okay, just to reiterate, prices are determined by this risk neutral, no arbitrage condition, and excess returns are defined as in the usual way, as the price tomorrow minus price today, plus the dividend you get between today and tomorrow. Under rational expectations.
5 more minutes.
Okay, under rational expectations, asset prices or excess returns are unpredictable, both according to the agents and under the true data generating process. In our framework, the agents believe that the excess returns are unpredictable, but in reality, under the true data generating process, we're going to have return predictability in asset prices. So we quantify the extent of return predictability due to using two classes of regressions. We denote them formal regressions and momentum regressions. In the formal regression, we regress excess return at time t plus h on the dividend or fundamental at time t. In the momentum regression, we regress the excess return at time t plus h on excess return at time t. Under rational expectations, since excess returns are unpredictable, the slope coefficients of both of these regressions should be 0 for all h's. But away from rational expectations, these slope coefficients could be non-zero, and we're going to look at the term structure of these coefficients to inform us about deviations from rational expectations, different horizons. The main result of the paper is a characterization result that characterizes these slope coefficients at every horizon as a function only of two objects. The first one is the autocorrelation function of the fundamental, and the second object is k, the number of factors in the agent's model. Okay, so this is a characterization result that tells you how to compute these coefficients, but it's a little bit of a messy result, so I'm not going to get into the details. Instead, I'm going to illustrate the result in the context of application to foreign exchange markets. Okay, so we're going to look at foreign exchange markets in which the fundamental is going to be log interest rate differential between a foreign currency and US. In our empirical exercise for the foreign currency, we use a weighted average basket of multiple currencies. The price here is going to be the log exchange rate expressed as the US dollar price of the foreign currency. And no arbitrage condition is the standard log linearized UIP condition. Okay, so the currency risk premium is going to be the notion of excess returns in this application, and the formal regression is going to reduce to the standard 1984 formal regression. So in particular, we're going to regress currency risk premium at time t plus h on log interest rate differential of deposit rates at time t. Now look at the coefficients of that regression. So here's what you see in the data. This is kind of a robust finding. You see in the short horizons, you have the famous four-var Decomposition of Palma. A more recent but still very robust finding is the predictability reversal puzzle. So in the short horizons, currencies with high interest rates tend to appreciate relative to what is expected from the UIP conditions. In medium terms, the pattern tends to reverse. Now we're going to look at, this is purely the empirical exercise. Now we're going to look at the predictions of our model and compare it to what we get from our empirical exercise. So again, our fundamental is going to be log interest rate differential. This is something that we can observe directly, and then we can construct the autocorrelation function of the interest rate differential, and then we can plug it into our characterization result and compute the beta coefficients at every horizon as a function of k, the number of factors in the agent's model. Okay, so here's the expression for k equals to 1. When k is larger than 1, we don't have a closed form expression.
One more minute.
Okay, thank you. We can compute numerically. Okay, so the beta coefficients only depend on the ACF of the interest rate differential and do not use any information on exchange rates and currency risk premium. Okay, so this is basically the main empirical result of the paper. You see that the model can generate patterns that are qualitatively similar to what we see in the data. The magnitudes don't match, but the general pattern of having the forward discount puzzle and then return the predictability reversal puzzle, you can clearly see it in the model implied coefficients as well. Now let's look at what happens when we increase k, and let's first look at the was a correlation function of agent's implied model and compare that to the true model. In the black line here, there's what we see in the data. This is the ACF of the interest rate differential. As we increase the number of factors in the AGS model to 2, 3, and 4, we see that the agents fit the ACF of the data, the ACF that we see in the data better and better. So we should expect to see less return predictability in asset prices. Okay, so we see that here on the left-hand side, again, I have the same figure as before for the case where the agents have one-factor models. As you increase the number of factors, you see that the return predictability mostly goes to zero. All right, so in the paper, we have another application to equity and momentum and reversal in equity markets. But let me, in the interest of time, conclude. We have a model where agents or investors can only entertain factor models with a small number of factors. Our model has only a single degree of freedom, which is the number of factors k. The model implies rich dynamics for term structure deviations from rational expectations. And we looked at one application in this talk where we looked at the Fama regression for foreign exchange markets. All right, thank you so much.
Thank you, Puya. And discussing this paper, we have Dimitri Vayanos.
Okay, so I will share my screen now. Okay. All right. So thank you very much for inviting me to discuss this paper. So let me first summarize. So Puya, I thought was very clear his presentation. So I would be quite brief. So this paper studies how agents learn about asset fundamentals using low-dimensional models. So and the main theoretical results are, first of all, a characterization of the model of the low-dimensional model to which agents converge, and the implications of that for equilibrium asset prices and return predictability. Then they apply their results to understanding violations from UIP and also momentum reversal in the equity market. Okay, so the model is actually quite simple conceptually. So the idea is that there are some asset fundamentals that, so XT is the fundamental, ZT is some underlying factors. So there are n factors, and they evolve according to this linear system. So the factors, there are some matrices A star and B star. The epsilons are shocks. And there is a vector C star that maps the factors into the fundamental. The price today is YT, and is equal to the fundamental plus the expectation of the agents about the future price times some discount factor delta. So now agents entertain models that have the same general structure, but have a different set of the factors potentially. So there can be k factors, and things are, as Puya said, things get interesting when k is less than n. So agents cannot entertain as many factors as they are in reality. So the results are to characterize the model to which agents converge is described by A, B, and C, these matrices and this vector. And in a nutshell, essentially the model, there is a very elegant characterization. The model minimizes some distance, this Kullback-Leibler divergence from the true model. And then the paper goes on to compute the coefficients of this return predictability regression. So they define excess returns in the standard way, and then they do what they call a Fama regression, where they regress returns on fundamentals over different horizons, can be on fundamentals today and returns in H periods from today. Also the momentum regression, which regresses returns H periods into the future on today's returns, I mean past returns. And they show that regression coefficients are, they compute them explicitly. They are a function of the autocorrelation coefficients of xt plus of xt, and they get a closed form solution when the factors, there's just one factor. Agents can entertain only one factor. Then they go on in the application, and they apply their model to currencies, in which case the asset price, this YT, is the exchange rate, and the fundamental, the cash flow is the interest rate differential. Then they perform the Fama regression, and they find that for k equal to 1, when agents can have only entertain only one-dimensional models, the model-generated coefficients of that regression have similar properties, let's say, to the empirical ones. So they are positive for up to 2 to 3 years, and then they become negative. And also, Puya did not have the time to talk about this somehow, kind of as much to emphasize it, but also there are some interesting variation in the cross-section that the model can match, that the countries that have bigger coefficients are also in the data are also countries that do the same in the model. And then they do the same in equities, where they are the asset price is the price of a country stock index, and the cash flow is the dividend growth. There they do the momentum regression, and they find consistent with the empirical evidence that the model-generated coefficients are positive up to 7 months and then negative. Okay, so this kind of short-run momentum and long-run reversal. All right, so here are my comments. So first of all, I find I will comment on the theory and then on the applications. So I think that the model and the characterization results are very kind of simple conceptually and very elegant in that, I mean, simple, not simple, kind of is a simple structure, and they are very elegant. Of course, there is quite a lot of math that goes behind. So it's nice results, especially the characterization of the regression coefficients in theorem 1 that show kind of how these coefficients in the Fama and the momentum regression relate to the autocorrelation function. And also they get closed form solutions when k is equal to 1, which are particularly nice as well. Now, what I would like to push the authors to do on the theory side is to provide more intuition for their results, especially kind of to essentially to show the reader how the autocorrelation coefficients in the XT process, in the kind of for different plausible factor models, relate to the autocorrelation coefficients that of the mod generated by the model to which the agents converge, and relate to the regression coefficients coming out of that model. For example, does the convergent model generate an autocorrelation function that in some sense minimizes the distance from the actual autocorrelation function of XT? Kind of give us some intuition about how the underlying structure of the true model kind of affects the model to which agents converge beyond this kind of general characterization results, because this has to prepare a bit the ground for the application section. And also the other kind of comment on the empirical, the theoretical part is to relate their theory to other models of expectations formation. We understand that methodologically what the differences are, and the authors explain this very clearly in the introduction. But what are the differences in terms of predictions, let's say, relative to extrapolative expectations, to diagnostic expectations, whatever, to low small numbers, various other models of expectation formation. So, and then on the applications, as I said before, I think it's very nice that the model can generate some of the empirical regularities in the time series and in the cross-section, in the case of exchange rates. So, as Puya said, the magnitudes are a bit off by factors of 3 to 10. So, so they are smaller for currencies, for example, than the model-generated ones are in the data. Anyway, so it's a bit unclear why they use dividend growth for equities as opposed to dividend levels, which is what matters for the stock price. Perhaps, I guess, they do this maybe to have a stationary series. But anyway, so this thing I think needs to be addressed a bit more. So I think more intuition would be useful. That's kind of my main comment. Which properties of the fundamental, for example, which properties of the interest rate differential really matter for the model's ability to generate the empirical patterns. For example, somehow it seems that the way they generate this violation of UIP is that somehow agents believe that the interest rate differential reverts quite quickly relative to what it reverts in reality. So and okay, so why is this happening? Kind of why agents come up with a belief like that? On a related note, it will be kind of pushing a bit more to kind of convince us about their story, and that this is kind of a valid explanation of these puzzles. It would be nice to push a bit more in the direction of robustness, for example, to show us perhaps, bring out even some survey data on expectations and see to what extent the model to which agents converge, its features kind of match survey data on expectations, kind of the kind of then and then to just do a few, for example, for the equities, for example, they could perform some more kind of maybe a cross-sectional analysis similar to what they do for foreign exchange, kind of to show more kind of additional tests of the model, or even to perform the FAMA regression, kind of which is the value effect, let's say, kind of similar to the value effect for equities. So anyway, but overall, I think it's a very interesting exercise. It's very kind of done in a very elegant way on the theory part, and it's quite intriguing that it seems to work in some ways in the empirical part. So I think it's just a matter of developing a bit more the intuition and that kind of the robustness. Thank you.
Thank you very much, Dimitri.
Thank you, Dimitri. I think given the time, we will have to move straight to the next paper, but I see that some people are using the Q&A function, so I'm going to encourage that the audience members just use that to ask questions of the authors. Okay, so our next paper is Optimal Monetary and Exchange Rate Policies with Imperfect Financial Markets.
Okay, now I'm unmuted. Thank you very much for inviting us. So I'm going to talk about our earlier work, Musa puzzle redux and its implications for optimal monetary and exchange rate policy. So it might be a little surprising why the two are directly related. And so I guess it should become clear after a couple of introduction slides. So just to refresh, what is the Musa puzzle? Well, it is the fact that when there is a switch from a pegged nominal exchange rate regime to a floating nominal exchange rate regime, simultaneously there is a stark change in the equilibrium properties of the real exchange rate, right? And so the real exchange rate is a relative price of consumption baskets in the two countries. It's a real relative price. Nominal exchange rate is the relative price of currencies. It's a monetary object, and it's not obvious why the two should change their properties simultaneously, but that's what happens in the data, and it's just a very stark thing. So in particular, in 1973, when the Bretton Woods system ended, before that, the nominal exchange rate was very nicely pegged. It was like a system of pegs to the US dollar. And so the dollar against the other rich country currencies was very well pegged and very stable. And obviously, once the peg system was over in 73, exchange rates started to be volatile. And exchange rates are very volatile. So a typical exchange rate movement is something like 10, 12% a year, the US dollar against the currencies of other rich countries. And sort of the surprising thing is that during the peg period, real exchange rate was stable. It moved only by 1-2% a year, something that we expect of real macro variables, right? Consumption and output moved by something like 1 or 2% a year, and real exchange rate did the same thing. But as soon as you let the nominal exchange rate float, the volatility of the real exchange rate increased an order of magnitude, right? And so this is typically viewed as one of the most convincing evidence of monetary non-neutrality. Indeed, there is a change in the monetary regime, and it has the stark effect on a real variable. So it kind of suggests the monetary non-neutrality, and often it is interpreted as evidence of nominal rigidities, that if you look at the definition of the real exchange rate, if prices are sticky, inflation rates move slow, then nominal and real exchange rate will move together. So what we do in the Musa puzzle paper, we argue that, in fact, if you look at broader set of facts associated with the switch from a peg to a float, which we're going to call, broader set of Musa facts, then actually nominal rigidities are not sufficient to explain them. And in fact, they're actually even not necessary to explain it. And instead, overall, the evidence points towards the role of the transmission of monetary policy through the financial markets, through the risk premia in the financial market. So to make this point a little clearer, here's the a fuller picture. So you have the real exchange rate during the peg and during the float, and kind of at face value, it rejects the basic real business cycle models, because in those models, a change in the monetary regime should not affect real variables, right? And so this is kind of status quo in the literature. But if you add to that the behavior of other real variables, in particular consumption, the remarkable thing is that actually nothing really happened. Going from peg to a float, there was no change that is noticeable in the behavior of many macro variables, in particular consumption, but also output and inflation and GDP and many other macro aggregates that did not really change their statistical properties. And so this, we argue, rules out the simple New Keynesian models with sticky prices, right? And the reason is that in those models, they allow the real exchange rate to change its properties, but they would require other macro variables to change their properties as well. So if you believe in sticky prices that are the key reason why real exchange rate changed its properties, you need to see changes in properties in other variables, including inflation and output gap and so consumption. And so if you kind of look at these facts here, that real exchange rate is very volatile, in the order of magnitude more volatile than consumption, for example. This is kind of what we can call disconnect and volatilities, that there is this big gap in variances between the macro variables and the exchange rates. And so what we argued in our previous work on exchange rate disconnect is that in order to explain it, you really need a shock in risk sharing, in the UIP condition. Without that shock being an important driver of the exchange rate, it's nearly impossible to get disconnect and volatilities between the real exchange rate and the macro variables, because they're tightly linked by other equilibrium conditions, which don't have the shock. And so you kind of gonna recover equal volatility or similar volatility in macro variables and exchange rate. So, but now, once you bring in also the period of the peg and the float, it kind of increases the set of moments that you need to match. You not only need to match the disconnect in volatilities during the floating period, you also have to match the fact that from peg to float, real exchange rate changes its properties, while macro variables do not change their properties. And in this sense, Musa puzzle is kind of like a mother of all exchange rate puzzles, because it kind of has the peg period and the float period. And so you need to match the moments during the float and during the peg, right? And so what we argue is then essential in a model to match it is not just the shocks to risk sharing, not just the UIP shocks, but in fact that these shocks are endogenous to monetary regime, that the volatility of the shocks endogenously changes when you go from a peg to a float, right? And so we kind of argue that this is the only way to match these facts. And then the question is, what types of models can do that and what types of models cannot do this? So we build on a very large literature and a number of important contributions here, but I'm gonna keep going, and I will really quickly go through like some empirics and some theory, and then I will try to get to the implications for optimal policy in the end. So just quickly show you empirics. I mean, this is kind of stark, but one way to document it is to look at volatilities of different variables before the end of the peg and during the floating period. And you immediately, I mean, these are rolling window volatilities for the real exchange rate. And it just discontinuously jumps up by like something like 8 times, right? So the volatility during the peg period is like 2%. The volatility during the float period is something like 12%, right? But then if you look at any other variables, well, first of all, they're as stable as real exchange rate is during the peg, but also they hardly change their statistical properties across the peg. So for example, inflation doesn't really change its properties. Consumption doesn't really change its properties. GDP doesn't really change its statistical properties, right? And you can do this test more formally. The point is really not to say that there are no changes in the behavior of macro variable. The point is that the change in the behavior of macro variable is very small, hard to detect, of the order of maybe 5, 10, 15, 20%, while exchange rates changes by 5, 6 times, right? And so there is the stark gap that really kind of, you don't really need fancy statistical tools to document, right? Okay, and so what I'm gonna do first is kind of lay out a shell of the theory that's kind of useful to think about these facts, and then provide a specific model of something happening in the financial market that can be consistent with this fact. So the basic model will kind of focus just on the households, and in a way, it's not going to be all that important what happens on the production side of the economy, because it will be true for a variety of the production sides of the economy. And so on the household side, there is standard intertemporal optimization, and the assumption is that the households can invest in a set of assets. And so it's a 2-country model, so it would be home households and foreign households. And the question is to what extent they can exchange different assets. How much can they trade different types of assets, right? And so home households will have set J, foreign households will have set J star. And the question is, what are the assets and the intersection of that set, right? And so households in each country will face potential shocks, like capital control types of shocks, which will limit risk sharing, right? And so this would be exogenous limits to risk sharing potentially, right? And then on the goods market side, they consume home and foreign goods, and there are preference shocks, whether they prefer more the foreign good or the home good. And that's kind of another international possibly shock. And then on the production sides, it's really not essential for me to specify much what's going on. So I can think of this as like a reduced form where A is a aggregate labor productivity in the economy. It's a reduced form object. Labor productivity can change because of primitive productivity shocks, or it could change because of markup shocks in the economy, markups driven by something like taxes, or markups driven by something like sticky prices, right? It doesn't really matter. It just, the point is that we can summarize all types of shocks happening in the product market with that reduced form object, A, which is like productivity shock. And then finally, I will think in the reduced form about monetary policy as either stabilizing inflation, and that's the floating regime, or stabilizing the nominal exchange rate, which is the fixed exchange rate regime. Okay, and so it turns out, and so the surprising thing here is that we don't really need to know much about the economy. There are two conditions that would allow us to get to the result. One condition is the kind of conventional international risk sharing condition. So this thing inside, this is on the complete markets, this object inside is equal to 0 always, and this is the Becker-Smith condition, right? Essentially, relative consumption should co-move with the real exchange rate. And that's kind of the very simple case when you can make the same point is like, well, on the complete markets, you know that consumption should co-move with real exchange rate. If real exchange rate changes its properties, relative consumption should change its properties. Something that we don't see in the data, but arguably markets are incomplete. So the question is, does this argument generalize? And the point is, yes, that argument generalizes beyond the simple and complete market models, but you need two conditions. You need this risk sharing condition under incomplete markets, so this holds only in expectation, plus there are potential risk premium shocks, plus there are potential financial frictions to risk sharing, right? And you have the intertemporal budget constraint of a country. So just that the net present value of net exports, which also depend, net exports also depend on the amount of consumption that the two countries want to do. And they depend on the, international relative price, which can be summarized by the real exchange rate, which affects net exports, right? And so these two conditions have to hold independently of what happens on the supply side, right? On the supply side, you can have sticky prices or sticky wages, and if prices are sticky, they can be sticky in different currencies, and there could be all sorts of shocks to productivity or to markups in that market. And so we're gonna think of conventional models as those models where this object right here, which summarizes financial frictions and risk premia, does not change with the monetary regime. So if you write down a model where this shocks to risk sharing do not change between peg and a float, the models will have certain properties, right? And in particular, they will not be able to match the Moose effects, right? And so now, what types of models are such where the risk sharing shocks are not sensitive to the monetary regime? Well, it turns out that conventional RBC and New Keynesian models, they have very small risk premia that don't really move with stuff. They're just kind of small, right? And so as a result, those models are approximated kind of well by our definition of the conventional models. And so what happens in conventional models is that there exists kind of like a sufficient statistic which combines consumption and real exchange rate together. And you can prove that in conventional models, well, the result is exact on the Cole-Opsfeld parameters, but it kind of is a good approximation outside of the Cole and Opsfeld case, which we do numerically. So the result is exact on the Cole-Opsfeld. In that case, there is a particular linear combination of consumption and real exchange rate that does not change its properties when you go from peg to a float. So in an RBC model, neither real exchange rate nor consumption will change. In a New Keynesian model, both real exchange rate and consumption will change its properties, but in such a way that this linear combination of consumption and real exchange rate stays stable. right? So in a sticky price model, if real exchange rate is becoming more volatile under float, consumption must become also more volatile under float in a kind of Satan way. So this linear combination stays stable. And this is what we don't see in the data. In the data, this object changes its properties. So I already showed that real exchange rate changes its volatility while consumption does not. And so as a result, this object altogether changes its statistical properties, which sort of rejects this conventional model. So the question is, what do you need to do in a model to actually fix this? And the answer is, well, you need to write down a model where this thing is endogenous to
Alex, 5
monetary
more
policy.
minutes.
How many minutes?
5.
Perfect. So you need to write down a model where the risk, this risk premium shocks or risk sharing shocks are endogenous to monetary policy regime. And the model that works is the one of segmented markets, for example. It's not necessarily the only model that works, but in this model, it's particularly easy to get it. So what we do here, we kind of combine the structure of Gabex majority, where you have home and foreign households that can trade goods directly, but they can only trade assets through arbitrageurs. But arbitrageurs, in addition, need to trade with the noise traders who have this exogenous demand for different currencies. And so the difference from Gabex and majority is that this is not a model of financial frictions. This is a model of limits to arbitrage, where the arbitrageurs face risk. They need to hold the exchange rate risk, right? Because they're doing the intermediation between home and foreign households. And in the process of that, they take on the exchange rate risk. And they have to hold all of this exchange rate risk, which they are unwilling to do without a compensation. And the compensation for them is the UIP deviations that emerge in equilibrium. And so the way we modeled this arbitrageurs is like in Jean and Rose. So these guys, they maximize the expected utility of real returns on the UIP trades. So this is the return on the UIP trade. They have to take the exchange rate risk when they do the UIP trade, and they care about the real returns, right? So there is no monetary non-neutrality built into the objective functions of these guys. What these guys face is the nominal risk. And the government has the ability to turn on and off the amount of the exchange rate risk by pegging the nominal exchange rate. So the policy function for this arbitrageurs is that they will be willing to take positions if there are UIP deviations. So they will kind of take the positions in the direction of the UIP deviation, but they will be not willing to take big positions if they face a lot of exchange rate risk, right? And so when you write down the equilibrium condition in this economy, it turns out that the size of the UIP deviations would be proportional to demand for currency coming from noise traders and from the households. But the coefficients in these equations, they will be endogenous to monetary policy. If there is, if arbitrageurs face stable exchange rate, they are willing to do a lot of intermediation with small UIP deviations. If there is a lot of exchange rate risk, they require big UIP deviations, right? And so this is exactly the reason how non-neutrality emerges in the financial market. The government has the ability to control the equilibrium volatility of the nominal exchange rate using monetary policy, but this affects the policy function of intermediaries in the financial market, and this is the source of non-neutrality going from a peg to a float, right? And so as a result, the equilibrium system in the end looks like this is that budget constraint in flow terms. This is the risk sharing condition, but now the extent of imperfection and the risk sharing is endogenous to the nominal monetary policy regime, and this is the source of monetary non-neutrality. And I don't have very much time here, but essentially in this model, when the government can switch on and off volatility of the nominal exchange rate, and it can do that so by basically announcing that it will fix the exchange rate and actually not doing much more in this model. So to the extent the government makes that credible announcement, that it endogenously changes the policy function of the arbitrageurs in the financial market, and it switches on and off the volatility of the risk sharing shocks. And first of all, this is enough to explain a big gap in volatility between exchange rate and macro variables under the float, but also it explains that when you go from a peg to a float, you have a big change in the properties of the real exchange rate and little or no changes in the properties of the macro variables. What is the reason for that? Well, the reason for that is actually
1 minute.
The reason for that is that the monetary authority does not really have to depart too much from inflation stabilization, because it promises stable exchange rate, and all of the job in the financial market under the peg is done by the intermediaries that increase a lot intermediation when they face no risk. And the government, both under the peg and under the float, can essentially do stabilization of inflation and of the output gap without changing its policy very much. And as a result, macro variables don't have to change their statistical properties between the two regimes. Unfortunately, I'm out of time, but I wanted to set up the policy problem. Well, I will show you two things and I will stop here. So first of all, the question is, what types of models can explain the Musa puzzle? Well, we kind of argue that simple RBC and New Keynesian models cannot do the trick because they don't introduce any change in risk premium in the financial market. For segmented market models, on opposite, it's quite easy to do it because you say that all of the risk in the carried trades comes from the nominal exchange rate. If you change the properties of the nominal exchange rate, then you change the policy functions in the financial market. But then there is this question of all these models in the middle. So these are the models where markets are incomplete and risk premium terms are present. And the question is, can the intersection between endogenous risk premium and sticky prices generate this change in risk premium from a monetary policy regime? So in particular, if you have financial frictions and sticky prices together, could they do the same as the segmented markets do for you, right? But at the end of the day, this results in this policy trade-off, and I will stop here. So one part of the policy trade-off is the international Phillips curve. It's the Phillips curve in the open economy. And when you go from a peg to a float, under peg, you face a much steeper Phillips curve, much worse trade-off. Under float, the Phillips curve is flatter because a lot of the adjustment in the goods market can be done by the nominal exchange rate, right? And so having a floating exchange rate is good because it effectively kind of allows you to make prices more flexible and flattens the Phillips curve in the goods market. On the other hand, exchange rate volatility affects the financial market. Floating exchange rate, which is associated with a lot of exchange rate volatility, will create a lot of risk sharing shocks, right? Because the noise trade and shocks in the financial market will not be intermediated as well by the arbitrageurs. And as a result, they will harm international risk sharing. And so this introduces this policy problem for the government if it has only one tool, which is the extent of volatility of the exchange rate, it will have to balance the trade-off between the goods market and sticky prices and the financial markets and deviations from the risk sharing. If the government has multiple tools, it has the monetary policy tool and also interventions in the segmented financial market. In fact, it has the capacity to address both problems here and here, but it needs to directly offset the noise trade and shocks in the financial markets. So by itself, segmented market actually does not reduce the policy options for the government. If the government have multiple tools, in a way, it can achieve good allocations on the segmented markets because it's very powerful if it can directly operate in the segmented market. However, if there are limits to what the government can do in the financial market, then it introduces the trade-off. And let me stop right here.
Okay, thanks, Oleg. We have Ludwig Straub discussing.
Oh, let me stop sharing.
Great. So let me see if this works. Can you see my slides?
Yep.
Okay, perfect. All right, great. Well, thank you very much for having me discuss this paper. It's a super fun paper. I learned a ton from working my way through it. So it's really great that I get to discuss it here. So this paper is about the Musa puzzle, and I'm going to start. By the way, I didn't have much to say on the policy yet because I didn't see much of the policy paper yet. I have some thoughts on it, and I'm happy to give more offline to Oleg and Dima. So I'm just going to focus mainly on the Musa puzzle paper. So the Musa puzzle is based on this 1986 paper by Michael Musa. And basically, he documented, as Oleg very nicely presented, that after the end of Bretton Woods, nominal exchange rates started floating across a lot of advanced economies. And this is obviously a change in the monetary regime. It's a nominal shock. But then at the same time, you saw that the real exchange rate moved almost in lockstep with the nominal exchange rate. And so he basically interpreted that to mean that there is strong monetary non-neutrality. Let me just throw you one plot in Musa's original paper at you. from two of my favorite countries. So you see, Germany versus the US, you see that the nominal exchange rate at the bottom was basically flat up until 1970. Then there was some intermediate period in starting 1973. It just fluctuated around, and the real exchange rate basically moved 1-for-1 with the nominal exchange rate. And so if you interpret the movement in the nominal exchange rate as sort of the source as being driven by monetary policy shocks, then you immediately get that you can only have these persistent moves in the real exchange rate along with the nominal exchange rate if you have a median duration of prices that's very high, basically as high as the half-life of the real exchange rate. And so this implies that this is a very strong argument in favor of nominal rigidities. So there's two obvious problems with this. And the first one is already known, namely that price durations in microdata are much, much smaller than 3 to 5 years. And the second problem, and this is what Oleg and Dima point out extremely nicely, that with the prices this sticky, any monetary shock should have a large quantity response. But then if you look at the data, you actually don't see a quantity response when Bretton Woods ends. And so this raises the question of, okay, how can we make sense of these facts? And this paper does a very nice job of resolving both of these problems. Regarding the first one, it suggests that the change in the monetary regime is non-neutral in the sense that it enables a real shock to appear, and that real shock directly moves the real exchange rate. And so you do not need any price stickiness to get persistent movements in the real exchange rate. And on the second point, they basically appeal to their previous work on exchange rate disconnect and show that these real shocks that are enabled by the change in the monetary regime, these UIP shocks, cause very little of a quantity response, and that's why the quantity does not become more volatile after Bretton Woods. So what's the key argument in one slide? So basically they have a model where there's financial intermediation that's frictional across countries, just like Gabex-Montori and others. And the key thing here is that basically the position that these financial intermediaries take depends on the expected carry trade return divided by the volatility of the nominal exchange rate. And so when you rewrite this, you basically get that there's a UP wedge that depends on the position of these intermediaries times the volatility of the nominal exchange rate. And if there's some noise traders among those intermediaries, you can think of those positions, that this X here, as essentially being a source of shocks, a source of these UIP shocks. Now, if I transform this into a real expression by basically using the Fisher equation in both countries, I get that sort of a real UIP condition here, where there's also a UIP shock, and that shock is exactly the same as before. And what's very nice, what you can see directly from this expression, is that once you have an increase in the volatility of nominal exchange rates, just like from pre-Bretton Woods end to post-Bretton Woods end, you see that suddenly you switch on these UIP shocks, and they are not nominal shocks, they're real shocks. They appear, they move the real exchange rate directly. And so you do not need any price stickiness on top of that. So that's basically the nature of the monetary non-neutrality that's going on here. And that's why they can break it. I think that's beautifully done in the paper.
Let's take 2 more minutes.
Well, I'm going to have 2 sets of comments, broadly speaking on the nature of the disconnect and some of the literature, and then I'll conclude. So why do these UIP shocks have so little of an effect on the economy? And I think part of what's going on here is that the economy that Oleg and Dima use as an example is the US, and the US has a very low share of imported goods among consumption. Here they calibrated to 3.5% in that era. But I think what's interesting is that some of the countries in the Bretton Woods system actually were much more open. So for example, Germany all around the same time had imports relative to GDP of 20%. It's not directly comparable, but you get the sense of magnitude that it's larger. And I think what would be interesting is if you could take the model and speak to the different countries that had different shares of imports in consumption, and see whether the model actually predicts sort of the quantity co-movement patterns across the degree of openness. And I think that would be a great test. And one thing that's actually surprising in the results, in which they highlight, is that the correlation between, so it's not just consumption and output that are disconnected, but it's also things like net exports, right? I would have expected net exports to, at the very least, net exports, right, to co-move with the real exchange rate, but not even that co-moves very much. And I think part of what might be going on is that, that we're looking here at first differences at a quarter to quarter horizon, right? So quarter to quarter, if the real exchange rate goes up by, 2%, do net exports actually go up by 2% or not? And I think what's kind of interesting is that, there's a large set of papers out there that document sort of trade elasticities are different across different horizons. They tend to be, smaller in the short run and larger in the long run. I think it would be nice to tie that to that literature. Let me just throw you one plot that I found super interesting from a very nice paper by Bohm, Pandalay, Nahar, and Levchenko. And basically what they look at is, persistent tariff changes across countries, and then they see how trade responds. And basically, on the right, you see the trade response, and basically you see that the trade response is very sluggish. It takes this is 10 years until it maxes out. And I think, just throwing in some force that produces this into a model and seeing, what kind of disconnect can you get from that, I think would be super neat. We have a recent project where we played around with models for this, and we have our own simple model that generates, I think, a very neat way of doing this. Happy to tell you more, but there's unfortunately no time, but I think this would be interesting. And this does not just apply to net exports, right? I mean, lots of other macro quantities like consumption, GDP, they're all sluggish. Just think of the hump shape responses to monetary shocks that we all know and love. And I think some similar comments, maybe not to the same extent, might also apply there. So it would be nice to just do that comparison and see what kind of disconnect you can get from that. Then on the literature, a comment. So I've just...
Sorry, it's time to wrap up. I'm sorry.
Yes. Okay, I'm almost done. Basically, one comment on the literature, I found, some of these facts are already present in some earlier papers. So it would be nice, the paper's preliminary, so there's no literature discussion yet, but for the, future, would be nice to exactly position the paper with respect to some of the earlier work that also had looked at, the muted quantity response pre-post ending of Bretton Woods. And I'm going to finish on that comment. And there's obviously a large literature comparing, the merits of fixed versus flexible exchange rates. And I think that's, a super nice opening to discuss that. And your policy problem might go into that direction, because obviously, under a fixed exchange rate regime, right, you constrain monetary policy, which then should mean, according to some work that's out there, that actually you have more volatility because you can't offset some of the shocks that are hitting you. And so that almost goes, the opposite direction, right? You should, according to those theories, you should see a decline in macro volatility. And so I think it would be nice to speak to that. All right. So let me wrap up. This is a fascinating paper, and you should all read it. And I look forward to reading the final paper. Thank you.
Thank you for the discussion. And the last paper will be presented by Jenny Tang. And it's one paper with me.
Can you see the slides?
Yep.
Okay. So thank you everyone for sticking around for the last paper. This is work with Vanya on a fundamental connection, exchange rates, and macroeconomic expectations. So the goal of this paper is to look at a current consensus in the profession that exchange rates and macroeconomic fundamentals are disconnected. We saw some of this in papers previous in the session, where recent work is mainly trying to explain exchange rates using financial variables or financial shocks only. And we revisit this debate using a rich data set of macroeconomic surprises. So our main result here is that we find that high frequency macro surprises can actually explain on average about 70% of the variation in quarterly and nominal exchange rate changes. We then trace a connection between fundamentals and exchange rates through a novel estimation of a present value exchange rate decomposition in which we incorporate survey forecast data. And the main result we see there is that, interestingly enough, it's the excess returns or currency risk premium component that is also mostly driven by macroeconomic news, where we can explain about 50% of the variation. And this is interesting because this is a component that most people think of as being driven by purely financial factors. So there's a lot of related literature for this paper, but in the interest of time, I'm going to skip this slide. So today I'm just going to talk about first how we get exchange rate news from macro surprises. I'll then show you how we decompose exchange rate changes using our survey-based VAR, and then talk about how macro news drives exchange rate subcomponents. So for the exchange rate news specifically, we are showing that basically in the literature, despite a supposed disconnect at monthly and quarterly frequencies, we see that previous literature showing high frequency responses of exchange rates to macro news. And in this paper, we're trying to basically see how much variation in quarterly exchange rate changes can also be related to this macro news. So to do this, we construct quarterly news indices using high frequency surprises. To do so, we first run regressions at a daily frequency of exchange rate changes on macro news surprises. Here, it's a pretty long expression, but essentially what we're doing is we're regressing a one-day change in exchange rates on surprises that occurred today and in the previous 3 trading days. And importantly, we're also including in this regression lags of these surprises from the previous 6 trading months, where we're summing over months just to reduce some dimensionality in this regression. In this regression, each of the betas and deltas are vectors of coefficients where there's 1 for each macro indicator. So each macro indicator itself can still have a separate effect on the daily exchange rate change. And so one way to think about this regression is we're summarizing the entire dynamic response of exchange rates to each macro surprise using 10 coefficients. Then from this regression, we're constructing fitted values and summing those fitted values over each quarter, and that's going to be our quarterly macro news index for the exchange rate. And so then we run a quarterly regression of 1 quarter change of exchange rates on this macro news index. And so this method is akin to a method found in Altavilla, Giannone, Modugno 2017, but we make some important innovations here. And the most important one is that we're allowing rich dynamics in the response of asset prices to news. And so by that, we mean these lagged terms in the daily regression in the previous slide. So there are a couple of reasons that we think this is very important. One is that the interpretation of an announcement often depends on context from recent past announcements, and this is known as the scapegoat effects in work by Paquette and Van Wynkoop. In Chung and Chin, they also survey market participants and find that people trading exchange rates do actually consider past news when they respond to the current announcement. Secondly, there's slow-moving capital in these markets, and this can result in responses to macro news that spread out over long periods of time, as opposed to an immediate response to a macro surprise. Another innovation that we make is the inclusion of foreign news and not just US news. So the high frequency macro surprises that we use are surprises in data releases on activity, inflation, trade, and the labor market and monetary policy. What's important to point out here is that by surprises, we mean the actual value in these releases minus forecasts that we get from a couple of different data sources. So the fact that we're using surprises will help to mitigate the reverse causality from exchange rates to macro variables. Our sample starts in 2001 Q4 and it ends in at the end of 2015. So this shows you the R-squares unadjusted from our daily regressions of exchange rate change on macro news. So this is the regression from which we're constructing the macro news index. And the point of showing you these R-squares here is to show you that these macro surprises do matter for daily changes in exchange rates, but even using all these surprises and all these lags of surprises, we're not overfitting the daily data. We're seeing unadjusted R-squares of at most 11%. Then in our quarterly regression, which is the second step that I showed earlier, we see that these macro news indices can explain about up to 83% of bilateral exchange rate variation in the quarterly changes, and in a panel it explains 70%. And this is despite only explaining about 11% on an unadjusted R-squared basis at the daily frequency. So we see that macro news can indeed explain a large majority of variation in a quarterly exchange rate changes. When we break down those macro news indices into subcomponents by just splitting up the fitted values from different components of the first stage regression, we see that the longer lasting dynamics are a crucial element. So the contribution of just the contemporaneous macro surprises in the second line here are quite small, whereas the longer 6 month lags, 6 trading month lags contribution is almost the entire adjusted R-squared. When we break it down by types of macro news, we see that activity and inflation indicators are the most important, while the external contributions, so these are like trade balance, current account balances, are less important, as well as the monetary contribution. So then we want to understand how macro news is transmitted to exchange rates. And so we answer this with an exchange rate decomposition. So our strategy is to do a present value decomposition based on an accounting identity in which we just define an expected excess return from being long nominal 1 period US dollar debt and short country I debt. Using this definition, we iterate forward and assume the law of iterated expectations to obtain this decomposition of a 1 quarter change in the nominal exchange rate. And this decomposition can break it down into terms that are related to past relative nominal interest rates, as well as expectations over the entire future path of these relative nominal interest rates. The same terms for expected excess returns, and a term for long-term expectations of the nominal interest rate level, which we can then relate to expectations, changes in expectations over the entire future path of relative inflation rates. So in order to estimate these components, we need the entire future horizon of expectation for inflation, short-term nominal rates, and the nominal exchange rate. Existing papers use expectations implied by estimated VARs. One issue with this is that standard VARs can produce quite unrealistic expectations and have problems such as small sample bias. So our strategy for dealing with this is to borrow from the term structure literature in estimating the coefficients of the VAR with an additional goal of matching survey forecast data for these variables. And so one interpretation of this is it's a structured way to interpolate and extrapolate survey data that we do have to other horizons. We use data on the same 10 advanced economies over 1990 to 2015, where the variables in the VAR are the real exchange rate, some macro variables such as inflation, the GDP gap, and the current account to GDP ratio. We also add a number of important financial variables, including the VIX, the US TED spread, and empirical term structure factors for all the countries. We use survey data from the blue chip and consensus economics on nominal interest rates, both short-term, long-term, inflation, and exchange rates. We make some restrictions on the VAR matrix of coefficients itself so that it's not over parameterized. And importantly, the innovation here is that we're adding a set of equations that map our VAR implied expectations to the survey forecast that we have data on. And we're estimating the VAR coefficients to minimize the squared errors in both the 1 quarter ahead VAR equations and the errors in fitting survey data. So the survey data itself is not entering into the VAR, but it's a criteria for estimating the coefficients. And this method has been used in a similar manner to estimate term premium. So I'm just going to show you some in-sample fits of our survey data to show you that the same standard VAR, when estimated appropriately with the correct coefficients, can fit the survey data quite well. So this picture is showing short run expectations for the nominal interest rate and inflation. And you see that even a standard VAR fits the nominal interest rates reasonably, although our survey-based VAR is able to do a little bit better. You see a little bit better, more of a difference in terms of inflation expectations. Where it really makes a big difference is when you're looking at longer horizon expectations of both the nominal rate and inflation. And here is where you see that the VAR without surveys in the red line is really just not fitting the level or the trend in these long-term expectations correctly, but adding the additional criteria of fitting survey data to the estimation of our VAR produces fairly good in-sample fits. We're also able to fit survey for exchange rate
We need
forecasts quite
5
well.
more minutes.
So then using this, these estimates, we can calculate our components from our decomposition, and we can examine a few things that have been examined in past literature. So here I'm showing the results of decomposing this is a reduced form decomposition of the variance of quarterly exchange rate changes among our different subcomponents. So what we see here, this is the average of these variances and covariances across different currencies against the US dollar. We see that the short rate component is about half as volatile as the exchange rate change itself. The inflation component is about a tenth as volatile, while the excess returns component is almost equally as volatile as the exchange rate change. And we see a number of covariances that also reflect facts in the data, such as a monetary policy tightening in response to inflation and a FAMA puzzle. We can also do the decomposition in terms of real interest rates, and those patterns are similar to the nominal interest rate patterns. And the patterns are similar across other currency bases as well. The main thing here to note is that a lot of the previous literature has pointed to this high volatility of the excess returns component as evidence of the exchange rate being primarily driven by financial factors, because people have tended to think of this component as mainly being driven by financial shocks. However, what we want to point out is that macro fundamentals may still matter for these excess returns. And so we're going to then use our previous exercise to examine how these macro news are affecting each of these subcomponents of exchange rate changes. And so to do that, we're going to use the exact same methodology, but we're going to add a little bit to it. But we're going to add news indices constructed using not just the daily changes in exchange rates, but also the daily changes in short rates and the yield curve slope and curvature factors. And the main reason for this is that these turn out to be important for the nominal rate and inflation components, perhaps unsurprisingly. And so here I'm showing the R-squareds again from the first stage regressions at the daily frequency, and similar to the daily changes in exchange rates, these daily data on the yield curve are not overfitted either. So then this is showing now the adjusted R-squareds in the quarterly regressions of the exchange rate change and the subcomponents on this entire set of macro news indices. So the first line is the exchange rate change itself. And here I just want to point out that even adding these other yield curve news indices, we're not adding to the R-squared that much. So just a single exchange rate news index was sufficient for explaining 70% of variation in a panel of the quarterly exchange rate change. And then the next three lines give you the adjusted R-squareds for the other subcomponents. And here you see, quite interestingly, that even for the excess returns components, which had previously been thought to be driven by financial factors, our macro news indices are explaining in the panel 51% of the variation there. And we're explaining quite a lot of variation for the nominal rate and inflation components as well. So when we split our sample, we see that there's even greater importance of macro news in times of economic or financial turmoil, here defined as periods where either there were US recessions or that the US VIX was high. So just to wrap up, in this paper, we're using high-frequency macro surprises along with a novel survey-based exchange rate decomposition to document that macro news can drive a large majority of quarterly exchange rate change variation, up to 82% bilaterally and 71% in a panel of advanced economy currencies against the US dollar, where we're importantly finding that it's really the longer-lasting dynamics in the response to macro news that's a crucial element for explaining this large majority of the variation. Excess returns are still the most volatile component of exchange rates in our present value decomposition, where we're forcing the VAR to match survey forecasts, but these two are largely driven by macro news, up to 71% bilaterally and 51% in a panel regression. So these new facts all support theories that link macro variables to exchange rates through excess returns. Thank you.
Thank you, Jenny. And now our discussion is Domenico Giannoni.
Hi, everybody. It's a great pleasure to discuss this paper. Thank you very much for the invitation. Before I start, usual disclaimers apply. These are my views, not necessarily those of Amazon. So this is a very interesting paper. It shows that macroeconomic surprises explain the vast majority of variations in exchange rate changes at quarterly frequency. We are talking about a very large number, 70%. The paper also shows that an important part is it's important in explaining the currency risk premium rather than expectations. During downturns and when financial uncertainty side, this explanatory power is even larger. And this has important implication. It calls for theories that feature a connection between macro fundamental exchange rates through the currency risk premium. Here in this discussion, I will focus mainly on the first finding, because it's very, very important. This 70% ability of explaining of macro surprises to explain exchange rate. The outline, I'll talk about the literature about exchange rate and fundamentals at low frequency and at high frequency. These are two literature that this paper is very nicely connecting. Then I will go to the discussion and then some conclusions. So the most important paper that is related to the presentation is the Mies-en-Rogoff paper. We all know the Mies-en-Rogoff. Here, I only want to stress the fact that this paper talks very closely to Mies-en-Rogoff, because in their exercise, what they show is that when they do the auto sample, they are conditioning on the actual realized values of future explanatory variables. And they find that they cannot explain exchange rate variations. So the result of this paper, the paper by Jenny and Vanya, is saying that, if we knew in advance the surprises, the macroeconomic surprises, the data that are going to be released in the next quarter, we can explain 70% of the variations in the exchange rate. So this is from 0 to 70 is a big jump. The paper is based on in-sample. However, if you have a predictability of about 70%, this is very likely to hold also in auto-sample. The other part of the literature that is related to the paper is this literature on exchange rate and the fundamentals at high frequency. So based on very small windows around the announcement of macro surprises. And here the literature finds a very strong connection between exchange rate and the fundamentals. Also, the literature has found some important role to for the currency risk premium, very similar to the results presented here. And another piece of the literature in the high frequencies is this low frequency effect that was found first on bond yields. And the result there is that high frequency macro surprises can explain only a very small fraction of high frequency variations. So they're significant, but only a small fraction is explained. However, for bond yields, when you go to lower frequency, when you aggregate it quarterly, this explanatory power goes up. Previous work before this paper by Jenny and Vanya didn't find the same result for exchange rate. And here is just a very simple illustration of this low frequency effect. On the left hand, you have the bond yields. This is on top is daily frequency, monthly frequency, and quarterly frequency. You see that when you move from daily, it's about 10% of the variation, to quarterly, you would go to explain from 10% to more than 30%. However, if you look, this is something we did also with exchange rate, you don't find this effect. And the reason was clearly explained by Jenny is the fact that in the paper, Jenny and Vanya are not only controlling for the surprises in a very narrow window around the announcement, but also for lagged surprises, the month before, 2, 3, 4, up to 6 months before. And then there is a table in the paper that shows that actually what is driving the result is not the contemporaneous surprises, but are these lagged surprises the previous months. And this is essentially, if you just focus on this lag surprise, you explain almost the totality of the R square of the paper. Now, here are all the surprises for the case of the euro area and US, so the dollar euro exchange rate. The sample is 15 years, which amounts to almost 4,000 trading days, which is 180 months and 60 quarters. Now, the regressors here are 34 times 4 days. So these are these regressors here, plus 34 times 6 regressor here. Now, interestingly, these regressors here are sort of, it's 6 months when you go and count the regressors here. Because if you go and zoom in and look at how the regressors look like, so what happens here is that since surprises are, it's true that the sample is daily, but surprises are released discretely every month. When you go and compute these averages, this is the way the data set looks like. You see that there are some jumps. So there are some pieces in which is constant, which is more evident if you go and zoom. And these jumps are about 1 month, 21 working days, and which tells us that if you go and count the degrees of freedom, the variations are not daily since the variations are monthly. So maybe here we shouldn't compare this number of regressors with the trading days, but with something close to the months. Now we have 180 months and 200 regressors. So there might be a problem of overfitting and the curse of dimensionality, which, by the way, it's a little subtle because, as we saw in the results presented by Jenny, it's you don't see an inflated R square at the daily frequency, but some complicated effects can come out here. And here are some, unfortunately, I couldn't run the regressions because Jenny and Vanya couldn't share the data with me, but they shared with me the coefficients of the regression, for these lagged effects. And here is the histogram with the t-statistics of these coefficients. So here we have 204 coefficients, and here you see that the t-statistics, few coefficients are significant. Only less than 5% are larger than 2. So let me conclude. So this is a must-read paper. It solves the exchange rate disconnect puzzle after 40 years, and it reconnects exchange rate and the rest of the economy. It finds that long-lived effect of macroeconomic surprises beyond the immediate aftermath of the announcement are important. This is an important finding in the literature of a high frequency that was never understood before. It connects very nicely two strands of the literature, the high frequency and the low frequency, and also its implication for the theory that needs to be developed. Let me conclude with some words of warning. So there is a potential danger of overfitting and the curse of dimensionality, and this is because of this, since data are released at the monthly frequency, the variation are not really daily, so some additional analysis is needed there. So as a suggestion for further study, I would suggest looking at external validity, auto-sample fit, and subsample stability, and also reducing estimation uncertainty using regularization techniques. And this is something I've already talked with Jenny and Vanya, and they have it on their research agenda. So